Welcome back! When you think of the world's biggest companies, you probably picture Apple, Microsoft, or Amazon. But what about the giants, the US? Today we're pulling back the curtain on the massive corporations shaping the global economy, many you've never heard of. We're talking about companies with trillion-dollar valuations, revenues bigger than some countries' GDPs, and profits that are just staggering. These are the companies controlling oil, building the chips in your phone, and selling the world's most coveted luxury goods. We'll break down the top 50 non-US companies by three key metrics: market cap, revenue, and profit. Using data from Voronoi.com, we'll explore who's on top, why they're there, and what it means for you as an investor or consumer. So hit that like button, grab a snack, and let's dive in. Before we jump into the rankings, let's take a moment to clarify the three numbers that matter most when evaluating the world's biggest companies: market cap, revenue, and profit. These are the key metrics that help us understand not just how big a company is, but how it operates and what the market thinks about its future. Market cap, or market capitalization, is essentially what investors believe a company is worth. It's calculated by multiplying the share price by the total number of shares outstanding. This number reflects not just current performance, but also the company's perceived future potential and growth prospects. It's a snapshot of investor confidence. Revenue, on the other hand, is the total amount of money a company brings in from its sales of goods or services. It's a measure of scale and reach, how much business a company is doing globally. But remember, high revenue doesn't always mean high profits. Profit is what's left after all expenses, taxes, and costs are subtracted from revenue. This is the real measure of a company's efficiency, sustainability, and ability to generate value for shareholders over time. Why do we need all three numbers? Because a company can have massive revenue but razor-thin profits, or a sky-high market cap based on hype and future expectations, rather than actual earnings. Each number tells a different part of the story. For example, imagine Company A with $100 billion in revenue and $1 billion in profit, versus Company B with $20 billion in revenue but also $1 billion in profit. Which is better? It depends on what you value more, sheer scale, or the ability to turn sales into real earnings. Sometimes efficiency can be more impressive than size alone. The data from Voronoi.com brings all these numbers together, giving us a comprehensive view: who the market loves, who dominates in sales, and who manages to keep the most cash at the end of the day. These numbers are always in motion, shifting with the tides of the global economy. But by tracking the trends, we can see where economic power is moving and which companies are rising or falling on the world stage. So, to sum it up, market cap represents investor confidence, revenue shows sales muscle, and profit is what really counts at the end of the day. Each metric has its own story to tell. With that foundation in place, let's dive in and discover who the real global heavyweights are and what makes them stand out in today's competitive landscape. Let's start with market cap, the stock market's ultimate vote of confidence in a company's future. Market capitalization, or market cap, is simply the total value of a company's outstanding shares. It's a quick way to see which companies the market believes are the most valuable and often the most influential. At the very top sits Saudi Aramco, boasting a market cap of over $2 trillion. This oil giant isn't just the biggest company outside the US, it's one of the largest in the world, period. Its dominance in the energy sector makes it a cornerstone of the global economy. Next up is TSMC from Taiwan, the world's chip-making powerhouse, valued at an impressive $700 billion. If you own a smartphone, a laptop, or even a car with smart features, there's a good chance TSMC made the brain behind it. Their chips are everywhere, powering the digital age. In third place is LVMH, the French luxury conglomerate with a market cap exceeding $400 billion. High fashion, champagne, and handbags, LVMH proves that luxury is big business. Their brands set global trends and command premium prices, making them a symbol of aspiration. China's Tencent and Kuaishou Mutai also cracked the top 10, showing the immense power of tech innovation and premium brands in Asia. Tencent dominates social media and gaming, while Kuaishou Mutai is a symbol of prestige and spirits. Novo Nordisk from Denmark and ASML from the Netherlands highlight the rise of pharma and tech infrastructure. Novo Nordisk leads in diabetes care, while ASML's machines are essential for making advanced computer chips. What's missing from the very top? Industrial giants like Shell or Volkswagen. Despite their massive revenues and global presence, the market currently values tech, luxury, and pharma companies more highly, reflecting changing investor priorities. Samsung and Toyota represent East Asia's industrial and tech strength, with diversified portfolios and a truly global reach. Their innovation and scale keep them among the world's most important companies. The takeaway? Market cap isn't just about size, it's about strategic importance and future potential. Energy, tech, luxury, and health are the sectors where investors see the most promise and growth. These companies don't just make products, they shape the global economy. Their dominance tells us what the market values most and where the future of business is headed. Here's where it gets interesting. When you look at the world's biggest companies, the ones with the most revenue aren't always the most valuable in the eyes of investors. It's a surprising truth that challenges our assumptions about what makes a company truly great. Take Volkswagen, Toyota, and Shell as examples. These are giants in their industries, pulling in massive revenues year after year, but when you check their market caps, they actually lag behind many tech and luxury firms. Why does this happen? It comes down to thin profit margins and the unpredictable, often volatile nature of their industries. Even with huge sales, their profits can swing wildly. Now compare that to companies like TSMC or LVMH. Their revenues might be smaller, but their profit margins are much fatter and their market power is enormous. Investors are willing to pay a premium for that kind of stability and influence. ASML is the ultimate example. While it's not even in the top 10 for revenue, it holds a near monopoly on advanced chip-making machines. That unique position sends its market cap soaring, far above many companies with higher sales. Resource giants like BHP or Rio Tinto generate immense revenue, but their fortunes rise and fall with commodity prices, making investors cautious about their long-term prospects. The lesson here is clear. Market cap reflects perceived quality, future potential, and the ability to generate profits, not just raw size or sales numbers. High-revenue, low-margin companies are like cargo ships, massive and powerful, but slow to change course and vulnerable to rough seas. High-margin, high-market cap companies are more like speedboats, smaller but agile, fast, and able to command a premium because of their unique advantages. If you look at profit rankings, you'll see Saudi Aramco at the top, but also TSMC and the world's biggest banks, all prized for their ability to generate steady, reliable profits. Investors consistently pay more for companies with stable, growing profits than for those with risky, cyclical earnings, even if the latter have higher sales. In today's economy, how you make money, your business model, your brand, your innovation, matters far more than just how much you make. Unique products, strong brands, and tech monopolies are the real winners in the modern market. These companies can charge more, grow faster, and weather downturns better than their high-revenue, low-margin peers. The disconnect between revenue and market cap is the market's way of signaling which business models it believes in for the long run and which ones are built to last. Zooming out, you see clear regional patterns among these 50 giants. East Asia, China, Taiwan, South Korea, dominates tech and manufacturing. TSMC, Samsung, and Tencent lead the charge. China's mix of tech giants and massive state-owned banks shows its dual strategy, innovation, and state control. Japan's Toyota remains a manufacturing powerhouse. Europe's strength, luxury, and healthcare. LVMH, Hermes, and L'Oreal rule luxury, while Novo Nordisk, Roche, and Novartis lead in pharma. The Middle East is all about oil, with Saudi Aramco towering over the region. Australia and Brazil bring resource giants like BHP and Petrobras. The trend: the market values intangible assets, brands, patents, and know-how over physical assets like factories or oil fields. Resource companies have huge revenues, but tech and pharma get higher valuations due to growth potential and stability. Each region plays to its strengths: Asia for tech, Europe for luxury and pharma, and resource-rich countries for commodities. Big banks from every region, ICBC, BNP Paribas, HSBC, show that finance is a global constant. The global corporate landscape is a patchwork of regional specialties shaping trade, investment, and even geopolitics. So why should you care about these rankings? This list is a roadmap to the global economy. The rise and fall of these companies affects everything from gas prices to your next phone. For investors, knowing which sectors and companies command premium valuations is crucial for smart decisions. Ignoring non-US giants means missing out on huge opportunities. TSMC, ASML, and Novo Nordisk are global leaders. These rankings reveal economic trends and vulnerabilities. For example, the world's dependence on TSMC and ASML for chips is a major risk. The dominance of Chinese banks and tech firms shows the country's growing influence. For consumers, these companies are everywhere. Your car, your phone, your medicine, even your beer. Understanding market cap, revenue, and profit makes you a smarter consumer of financial news and a more informed investor. The competition between these giants drives innovation, better chips, new medicines, and improved products for all of us. But it also raises concerns about monopolies and concentration of power, which regulators are watching closely. In short, these companies shape the world you live in. Knowing how they work is key to understanding the modern economy. Where do we go from here? The list of top companies will look very different in a decade. The tech Cold War is heating up. Countries are racing to build their own chip industries, which could challenge TSMC and ASML's dominance. The green energy transition could create new giants. Will oil companies adapt, or will new players in renewables take over? China's tech giants face regulatory hurdles at home, which could slow their global rise, or, if unleashed, make them even more powerful. Europe's luxury and pharma leaders must innovate to stay on top, especially if economic conditions change or competition heats up. New sectors like artificial intelligence could catapult unknown companies into the top ranks almost overnight. Demographics matter too. Aging populations boost healthcare, while a rising middle class in India and Southeast Asia creates new markets. Geopolitics is the wild card. Trade wars and conflicts can reshape the corporate landscape overnight. The future is uncertain, but the battle for tech, energy, and new markets will define the next generation of global giants. No company's position is ever truly safe. It's going to be fascinating to watch. That's our look at the 50 largest companies outside the US, from Saudi Aramco's oil empire to TSMC's chip dominance. We've seen how luxury, pharma, and tech command investor respect, and how China is building its own corporate army. These companies shape what we buy, how we live, and where the world is heading. If you learned something new, hit like and subscribe for more deep dives. Which company surprised you most? Let me know in the comments. Thanks to Voronoi.com for the data. Check them out for more visualizations. Thanks for watching and see you in the next video.